Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie. In London, these are the stories that set your agenda. Central bank bonanza in Europe. Investors watch to see if the Bank of England will open the door to an August cut. The day after UK inflation slowed to the BOE's 2% target for the first time in almost 3 years. Policymakers in Norway and Switzerland will also have their turn. The Swiss National Bank's decision on a knife edge 3 months after it delivered a surprise cut. Plus, a barrage of new polls show UK Prime Minister Rishi Sunak and his governing Conservative Party on course for an electoral wipeout, with Keir Starmer's Labour potentially set for an historic majority. Let's check in on these markets then. Asian markets giving up some of the gains that had come through in the earlier part of this week. Of course, the US is back later today after the holiday of yesterday, looking for direction, it seems, these equity markets. European futures pointed to modest gains of 0.2% after European stocks struggled for direction yesterday. The FTSE 100 looking to add 22 points so far in the session. S&P futures, of course, back after that holiday, as I mentioned, looking to gains of 0.3% to build on the records that continue to be punched through by the S&P with that tech input, of course. Nasdaq futures looking to add 115 points, rallying right now in terms of Nasdaq futures, looking to add 0.6%. Let's flip the board and look cross-asset. In terms of the data, we do have the non-farm payrolls later, but it's the US jobless claims that we're going to be focused in on today out of the US. That, of course, after the decision from the Bank of England, expected to stay on hold, but it's the statement and any changes around the language that will be crucial, and whether or not they guide to a potential cut in August. Markets paired some of their bets around that as a possibility yesterday on the back of the inflation data. The US 10-year currently at 4.24, yields up 3 basis points after a bit of selling pressure across bonds in Europe yesterday. The pound at 127. Of course, we watch the pound in the run-up to and on the back of that decision from the Bank of England. Brent, $85 a barrel, up 0.1%. The inventory story and details out of the US, that data expected to come out, that weekly inventory story later today. 2,340 on the yellow metal. Gold up 0.5%. A pretty decent session so far for gold. Now, the Bank of England is expected, as I mentioned, to keep rates steady later today, with the impending UK election, of course, making a move more difficult. The latest reading of services inflation came in higher than expected, even as CPI, the headline, fell to 2% in the year to May. Let's get more then from Bloomberg's Lizzie Burden, who's outside the Bank of England for us. Lizzie, is there anything that markets should be watching out for today, given that the expectation is, of course, that they will stay on hold?
Well, you're absolutely right, Tom. You already saw a market reaction yesterday off the back of that hot services inflation reading. You saw a tick up in gilt yields, you saw a tick up in the pound off the back of that number, and it kind of lets the MPC off having to cut rates today, but they already seemingly had ruled one out, a cut, because of the election. It seems like that's going to have to wait until after the July the 4th election. We haven't had any speeches from the Monetary Policy Committee in the time since the snap election was called, and therefore we're expecting the vote split to be the same today, 7-2, 7 to hold, 2 to cut. But what could be interesting, Tom, is the next meeting, because this is the last one for the Deputy Governor, Ben Broadbent. He's going to be replaced by Claire Lombardelli, and she's thought to be a little more hawkish, so perhaps we see a change in the dynamics on the committee. But as you say, no presser, no forecasts today, and we're expecting the guidance around the decision to remain the same. They've already gone towards an easing bias.
And as you say, look, they are constrained in terms of the communication because of the politics. And on the politics then, Lizzie, another round of polls just reminding us of the challenges facing Rishi Sunak and the Conservatives at this point as we count down to July the 4th.
It looks like the Conservative Party, Tom, is on for electoral annihilation. 3 polls suggesting so, including one suggesting that the Prime Minister himself is going to lose his seat. And indeed, at this point, Tom, it's the polls leading the narrative, not the other way round. The Defence Secretary, Grant Shapps, has been on the broadcast rounds talking about how it's less about winning the election and more about reducing the scale of the Labour victory, reducing the losses for the Conservatives. That is notable in itself, Tom. Things are looking bleak for the Conservatives at this election.
Yeah, that's a significant adjustment in terms of the messaging, isn't it, from senior Conservatives. Bloomberg's Lizzie Burden outside the Bank of England on the central bank decision upcoming later today, and, of course, the politics of the UK. Lizzie, thank you. Now, on Monday, UK Business Secretary Kemi Badenoch and Shadow Business Secretary Jonathan Reynolds will go head-to-head in a live televised debate moderated by Bloomberg's Francine Lacroix. They're going to also face questions from Britain's leading business groups. Catch the business debate, 12:30 p.m. UK time, Monday, on Bloomberg TV, on the terminal, the website, YouTube, and on Bloomberg Radio. Over in Switzerland, we are expecting a nail-biter decision from the SNB today. The Swiss National Bank was the first among advanced economies to start loosening policy when it made a surprise cut in March to 1.5%. Let's get more then from Bloomberg's Swiss economy and government editor Bastian Benrath in Zurich. Bastian, what is the SNB expected to do? It seems the economists and traders are split and divided on this.
They are indeed. Good morning, Tom. Thanks for having me. Well, it's a very, very open decision, even for S&B standards. S&B is good to surprise markets. We know that from the decision in March, also from the time when they abandoned the cap on the franc back in 2015. So we can definitely see a lot of movement coming, and the franc volatility is as high as we haven't seen it from 2015 anymore. The thing is, the big question is, how will they see the franc? Because the currency has appreciated, has started to appreciate last month, and the question is, has it gotten too strong? Because if it has, then policymakers are likely inclined to go on their pace and cut again, even though other global peers like the European Central Bank and the Fed are very, very hesitant about easing.
OK, so the relative strength, at least recent strength of the Swissy is going to be a factor, clearly, for officials and members of the SNB as they make this decision. Talk to us about that uncertainty, though, and how the inflation story in Switzerland ties in to that conversation.
Well, inflation in Switzerland is very low by international standards. It's just at 1.4%. That's like significantly lower than in the Eurozone or in the UK or the US. But the thing is, it hasn't softened in the last two readings. So 1.4% is the year high. And the fact that it hasn't really retreated from that high would usually be a good argument for the SNB to say, let's take it easy, let's not cut now. But then again, you have the franc on the other side. And some people argue that the franc and the franc exchange rate is actually more important to this little open economy, which Switzerland is, more than interest rates. So it's really a question where policymakers will set the priorities. The thing is, they are not exactly forthcoming in their communication. So we just don't know what they think. We will just see, we'll just be surprised when they announce their decision at 9:30 local time in Zurich, 8:30 in the UK.
And meanwhile, of course, we are getting ready for change at the top of the SNB with Thomas Jordan stepping down after the next couple of meetings. To what extent is that going to bear at all on the decision today, the upcoming departure of Thomas Jordan?
Quite honestly, I don't think so much. A lot of people are speculating about that. But honestly, Thomas Jordan is just really a very hardwired economist, and he will just do whatever he sees best for the economy. I don't think the decision will have, or the fact that he is about to depart will have any impact on the decision which is going to be made. Also, the most likely candidate, we don't know who will succeed him, it hasn't been announced yet, but the most likely candidate is his vice president, Martin Schlegel, and he's just very much like a follower of Jordan. He actually joined the SNB as an intern to Thomas Jordan. So we don't expect any particular change in policy. It's pretty much going to go on, and policymakers in Zurich will just look what they think is best for the Swiss economy.
OK, fantastic setup ahead of the SNB decision later today. Bloomberg's Swiss economy and government reporter Bastian Benrath out of Zurich for us. Thank you. We're going to be speaking with the SNB President Thomas Jordan, by the way, after that rate decision. Of course, one of his final interviews before he steps down. So stay tuned for that interview as well. Let's get the market reaction in terms of how the markets are gearing up for these rate decisions from the BOE and the SNB, with Mark Cranfield from Bloomberg M Live standing by for us. Mark, so the SNB looks to be, as we were hearing from Bastian, a very, very close call. How are the markets kind of preparing around this decision, with the eye, of course, on the Swissy as well?
Yeah, it's all about the Swiss franc, and traders need to try and figure out, is the Swiss National Bank ready to blunt the strength of the currency now, or are they going to wait a little bit longer until they do it? That's really what the whole decision comes down to today. And what we've happened is that the Swiss franc has once again proved itself to be the ultimate haven currency. So in the recent weeks when we've seen some disturbances because of elections, whether it's in France or the UK, or we've seen geopolitical tension, people have just flooded into the Swiss franc. It is extremely strong against most currencies, especially against the euro. That's where people measure really how strong and how far the currency is going. So that euro against Swiss franc cross has seen the Swissy appreciate a lot. And that's now the decision for the Swiss National Bank. They're very sensitive to moves in that. As Bastian was saying, it's an open economy. They depend very much on their currency to help to modify inflation, which it's been doing. But there are times when the currency gets too strong. That could well be one of those periods. But they may want to wait a little bit longer because we still have the French and the UK elections to come. If there are further disruptions in European markets because of those two votes, even more money will flood into the Swiss franc. So they may decide to wait a little bit longer to see if the Swissy strengthens even more, and then maybe they will respond to it. So quite likely the final move for them will be it's a little bit too early, but at some point they will want to weaken the Swiss franc a little.
OK, the Swissy is a safe haven amidst the political challenges of the Eurozone. Meanwhile, we're looking at cable at 127, Mark. We saw gilt yields up, bit of selling pressure across UK debt, particularly at the front end yesterday. How much is priced in ahead of this decision from the BOE?
Probably a bit already, particularly in terms of yields have come down a fair bit. We've got the 10-year gilt yields getting close to 4%. They've fallen reasonably over the past few weeks. That's partly because they're following what's happening in the treasuries as well, but also because of anticipation, as Lizzie was saying earlier. There is probably going to be a setup to suggest that interest rates will come down sometime during the summer in the UK, and traders are positioning for that. But there's certainly room for gilt yields to pop a bit higher because treasuries are also beginning to stall. There's an election coming in the UK. The Bank of England could be a bit more cautious than people expect today. They really will want to tread a very fine line where they don't give anything away to help either political party. They're also aware that the Fed is taking its time to lower interest rates as well. And although inflation came down to their target, some of the services numbers are still a bit on the high side. So we actually may get a slightly more cautious approach from the central bank. That could see gilt yields going back up a little bit. Stock market can probably take it in its path anyway because of what's happening in the rest of the world where markets are so buoyant, especially the US, as you were saying earlier. So all in all, the most likely place for action today is in the UK interest rate market.
OK, so markets further in terms of the positioning, potentially further upside in terms of UK yields as we lead up to that BOE decision. On the back of that BOE decision, potentially more caution from this central bank, particularly given the services inflation component. Bloomberg MLive's Mark Cranfield on how the markets are positioning ahead of the SMB and the BOE. Thank you from my MLive team with a market lens and analysis there. Here's what else we'll be thinking about then, as well as the SMB and the BOE. We do have Norges Bank as well. Their decision coming at 9 a.m. UK time. We will, of course, break that for you. And the question for the Norges Bank is to what extent they push out expectations of when they cut, given the ability for that economy to be relatively resilient in the face of rates at, 4.5%. The economy is showing that resilience. To what extent do they guide the first cut and push that back in terms of market expectations? That will be in focus with the Norges Bank decision at 9 a.m. UK time. 7 a.m. UK time. Before we get to the Norges Bank, then, we're going to get details in terms of the health of the car market, the EU, 27 member nations, new car registrations. 7 a.m. UK time. So to what extent is the auto market of Europe holding up, as, of course, there are signs that maybe the Eurozone and its economy is starting to show a little bit more optimism. And what's the EV component within that as well? That will be interesting, given that growth has been slowing in that part of the auto market. 1:30 p.m. UK time, we're going to get the initial jobless claims out of the US. We've got unemployment at 4% now in the US. Will initial jobless claims edge up? What will it tell us about the relative cooling of the job market in the US? You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go. Coming up, China dropping hints on how it will punish the EU for its proposed tariffs on electric cars. Details on how Beijing is thinking about its response coming up This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Thursday. Now, China is said to be preparing a series of retaliatory actions against the European Union for its proposed tariffs on electric vehicles. The likely targets include alcohol, cars and food products. This, of course, coming after Beijing said it was launching a probe into EU exports of pork. Let's bring in James Megan now, joining us out of Beijing for the details on this. James, what do we know? Which sectors are potentially vulnerable? Which companies are potentially vulnerable as Beijing draws up this list?
So I think the first two things are pork producers and brandy producers. Brandy is almost 99% of brandy producers exporting to China and France. Pork production mostly in Spain, some in Denmark, a little bit in other places across Europe. So those are the two sectors that China has already announced that they've started anti-dumping investigations into, and this is a way of them imposing tariffs in a way that would be WTO compliant or might be WTO compliant. There's also been some threats made against other industries, wine, dairy, the aerospace sector as well. That's sort of through state media channels or through trade associations, so a little bit less official than the Ministry of Commerce actually coming out and starting an investigation. But those are the sectors where we're looking at so far. And if you look down where those are from, it's concentrated in some countries where the Chinese think they may be able to swing some support against the tariffs. So if they can swing the Spanish government to oppose the tariffs in the EU, if they can convince enough Germans that they'll put German car companies that they'll put tariffs on German cars, and convince the German car companies to lobby Berlin about the tariffs, I guess the hope is Beijing is that they can convince enough European countries that the pain of Chinese retaliation is more than the benefits they might get from putting tariffs onto Chinese EVs.
Yeah, so interesting in terms of how targeted these potential measures could be, and in terms of how they hope to sway some members of the EU. On the autos front, James, we know on that point that the German Chancellor Olaf Scholz is concerned and has expressed those concerns about these potential tariffs on Chinese EVs. How then is China looking at German-made and European-made autos being shipped to China?
The current tariff on all cars imported into China is 15%. That was actually lowered during the trade war with the US, sort of an offer by the Chinese to try to avoid a trade war with Donald Trump, which didn't work. And China could re-raise those tariffs to 25%, and it's already hinted that it might do that, especially on European cars. I think if they were to impose that tariff just on European cars, that leaves them open to a WTO complaint. So they might impose it on Japanese and American cars as well. But obviously, the German auto industry is very concerned about that. Porsche, for example, exports most of their cars from Europe to China, so they would be hit. Mercedes-Benz, if you're driving a 7 Class, BMW, these are the very expensive cars, the really luxury cars of the luxury German car makers. These are all being exported into China, and so this is going to put them at a disadvantage in trying to compete against both other luxury cars like Lexuses or whatever, and also against the increasingly luxurious EVs that Chinese brands are coming out with. The real issue with Germany, though, is that it doesn't seem to really have a unified position on this. You have some people coming out in the government as incredibly opposed to this, like Volker Wissing, the transport minister. You have the foreign minister coming out, and Lena Baerbock coming out in totally support of the tariffs. We have the vice chancellor is going to arrive in Beijing tomorrow for discussions specifically on this issue with the Germans. With the Chinese. But it's very unclear whether he can present a unified German position either from the perspective of the government or from the perspective of industry, because there's other parts of the car industry in Germany and other industries in Germany that are actually quite supportive of this. So obviously the Chinese are trying to lobby and threaten the German government and German car industry about these tariffs, but it's hard to imagine that Germany is going to get unified behind one or either position anytime soon.
OK, James Mager in Beijing on how Beijing and officials, of course, in the Chinese capital are looking at gearing up that retaliatory action, potential retaliatory measures, of course, to the EU and some of the EU products being shipped to the world's second largest economy. James, thank you very much indeed. In other news then, Vietnam welcoming Russian President Vladimir Putin, underlying its decades-old relationship with Moscow in the face of US criticism over the Kremlin's invasion, of course, of Ukraine. Putin arriving in Hanoi from North Korea, where he signed a comprehensive strategic partnership with Kim Jong-un. Vietnam is brushing aside Western criticism of its invitation to Putin, who last visited Vietnam in 2017. The US Embassy in Hanoi said, quote, "No country should give Putin a platform to promote his war of aggression." Coming up, Manchester United's new co-owner tells Bloomberg why he fears for the future of the Premier League. More from that exclusive interview next. This is Bloomberg. Welcome back. The new co-owner of Manchester United says people running the Premier League are in danger of ruining the world's richest football competition. He spoke exclusively with Bloomberg's Francine Lacqua.
I just think the Premiership needs to be careful it doesn't get itself into an endless legal wrangle with, lots and lots of clubs, because at the end of the day, the Premiership is probably the most successful sporting league in the world, certainly the most successful football league in the world. And we have this expression up north in England, if it ain't broke, don't fix it. And, you have to be careful if you start interfering too much, bringing too much regulation in, and then you finish up with the Manchester City issue, you finish up with the Everton issue, you finish up with the Nottingham Forest issue, and on and on and on. And if you're not careful, the Premiership is going to finish up spending more time in court than it is thinking about what's good for the league. And, we've got the best league in the world. Don't ruin that league, for heaven's sake. And then there was all this conversation about anchoring, what would anchoring do? Anchoring would that would inhibit the top clubs in the Premiership. And the last thing you want in the Premiership is for the top clubs in the Premiership not to be able to compete with the Real Madrids, Barcelona, Bayern Munich, PSGs. I mean, that's absurd. And if it does, then it ceases to be the finest league in the world. So people have to be... And then we've got the government regulator. We're now talking about a government regulator coming in. And they, if you've got a government regulator, at the end of the day, they'll interfere. And that won't be good. So, I have a few concerns about the Premiership in that, when Richard Scudamore ran it, it was a really fine league. It was very successful. And over that, I don't know how old the Premiership is now, 15 years, it became extremely successful. And then everybody starts interfering and messing about. And that's, my view, is not good.
So do you worry about the people in charge? Is it a personality concern about?
No. It's not about. I don't know how they drift. I've only been in football for 6 months. So
well, you've been following it for a long time.
No, that's true. No. I know Alison. She's a very sensible lady and what have you. But no, I think that drift into complexity that's unnecessary. I think people just need to stand back and think about whether that's good. They should remember what the Premiership's about. It's the best league in the world.
That was Ineos founder and chairman Jim Ratcliffe speaking exclusively with Bloomberg's Francine Lacqua. Coming up, I'm going to speak exclusively with HG CEO and managing partner Matthew Brockman, one of the most significant PE names, particularly in the tech space here in Europe, with a focus on AI. That is next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. Central bank bonanza in Europe. Investors watch to see if the Bank of England will open the door to an August cut. That's the day after, of course, the UK inflation story slowed to the BOE's 2% target for the first time in almost 3 years. Policymakers in Norway and Switzerland will also have their turn. The Swiss National Bank's decision on a knife edge 3 months after it delivered a surprise cut. Plus, a barrage of new polls show UK Prime Minister Rishi Sunak and his governing Conservative Party on course for an electoral wipeout, with Keir Starmer's Labour potentially set for an historic majority. Let's check in on the markets then. US futures pointing to pretty decent gains, actually, as the US comes back today, later today, of course, after the holiday of yesterday, and, of course, the fresh records that were pushed through by the S&P earlier this week. And looking to build on that in terms of US futures, with S&P EMEA looking to gains of 0.3%, but the Nasdaq futures now pointing higher by 0.6%. European stocks also looking for a little bit of upside, coming up, pointing higher by 0.2% after a challenge day. They ended lower by around 0.2 yesterday, looking to make up for that today as things stand. The FTSE 100 looking to add around 20 points. And as I said, S&P futures and Nasdaq futures pointing higher as well. Let's flip the board cross asset. A bit of a catch-up in terms of the selling pressure across the bond space. You saw that pronounced at the front end in terms of UK debt yesterday on the back of the inflation data showing that services remains sticky. So there's a bit of catch-up in terms of what you're seeing on Treasuries. 4.24 on the benchmark 10-year, yields up just shy of 3 basis points. We have jobless claims out of the US later today, which will give us a bit more detail in terms of the health of the labour market. The pound, of course, in focus for us today. Cable at 127 ahead of that BOE decision. Expected to stand pat at 5.25, but it's whether or not the statement gives that guidance in terms of August. Markets, though, paring their bets on a potential August cut from the BOE. Brent, $85 a barrel, up 0.1%, and gold having a pretty solid session as well. The yellow metal up 0.6% at 2,342. Now, Citigroup says finance industry jobs are more likely to be affected by artificial intelligence than any other sector. According to a new report from the American bank, 54% of jobs across banking, 54%, have a high potential to be automated. Joining me for an exclusive conversation now on the AI shift across industries with a particular focus on tech and software is the CEO and managing partner of HG, Matthew Brockman. HG, the third largest PE group in Europe and one of the largest backers, the largest backer of scaled software companies with, 70 billion funds under management. Matthew, thanks for joining us in the studio. Let's start there then in terms of the disruption across the labour force and the focus particularly on financial services. Does that report, does that data, does that estimate from Citi chime with what you're seeing?
Gen AI is clearly one of the major technology shifts of this, these decades, right? You probably go back to the internet to get the last sort of scale of change that we're about to see. And I think this is great sort of Bill Gates quote, which is like, it's easy to overestimate the speed of which things change, but underestimate the pace of which or the impact of which things will change. So our view is you'll see a bunch of stuff early now, which you're seeing using AI around productivity and development and so on, which is happening. But the real long-term effect will be in the white-collar services sector. So, finance would be obviously impacted in terms of there are hundreds of thousands of people working around us in the City of London. How they conduct their jobs, what work they have to do and so on will be significantly impacted by technology and the automation of that workflow as AI really gets developed and rolled out into the workplace. And
I think what's really, really interesting about talking to you is you have this touch point. You have about 50 companies within the portfolio. Many of them, most of them focused within the software space. So you have a real granular feel as to how those companies are adjusting and the demands of their clients as well. So in terms of, presumably there are some within that portfolio who are facing a threat from generative AI, others who are looking at an opportunity. How are your portfolio companies adjusting to generative AI?
Yeah, so our portfolio in aggregate is about 150 billion of enterprise value, right? So we've got about 50 companies, as you say. I would split it again between the sort of short term and the long term. The short term is almost all of those companies are using Gen AI for improving the way they develop their software, for the way they serve their customers, like the sort of margin impact or value of being able to do more with automation is clearly being shown up in the P&L and in the cash flow of those companies. So short-term effect, very sort of, I guess, positive for software and very pronounced. The longer-term effect, as Gen AI really works out into the workforce and into the application, will then when you start seeing some of these labour effects coming through. So what we spent a bunch of time on now, and we had a bunch of our CEOs and sort of industry people together a couple of weeks ago in Lucerne, was around how do you think about the long term, the kind of 5, 10, 15-year impact of this, and building products now which will automate the finance jobs that Citi talked about when you opened up the conversation. So how you think about developing product and the kind of long-term implications is really where we're trying to put our effort, because the short-term stuff is actually really quite clear by now.
Does that suggests that you're maybe a little bit more sanguine about this debate? There's been a lot of focus in terms of the spend, the massive capex coming through on the hyperscalers, around data centres, around the chips, but the relatively small amount that's coming through in terms of the monetization story. But you are seeing accretive benefit for your companies as they invest in AI.
Yeah, so you've got the people building the foundations, right, the models and the infrastructure and the capex that's needed to put all of that data center and all that sort of chip capacity in place. That's undoubtedly been playing through, and there's going to be a handful of players that are doing that. As it starts then coming into the workflow and application, that's when you start seeing how it benefits or works with our portfolio. So, I say you're seeing this stuff which is shorter term, which is almost certainly more productive, more margin. There's a couple of points of margin in how you produce software, how you serve customers. You just need less people to do that workflow. As you then start coming out more medium term into how lawyers work, how finance professionals work, how people trade on the markets, how doctors conduct themselves, the AI piece of that will be very magnified. So their daily job, their daily workflow, how they engage with their patients or their customers or other brokers will fundamentally shift, because people are just going to be able to use. It's intelligence for the first time, right? The software is actually intelligent in terms of the way it interacts with you.
Is that where the next wave of value creation comes from then?
Yes. Yeah. So for us, I would say we have a bunch of software companies doing, workflow and automation of different jobs. We almost certainly are more efficient in terms of how that gets delivered today. Our big focus, if we have a legal software company, our big focus is how do we build products which is going to make, lawyers working in law firms surrounded here in London or in New York more productive, and how does the AI piece of that change their day? Because they won't spend 20 hours on a document, they'll spend 5 minutes on a document, because the AI will drive an awful lot of the creation and the review and the collation process that lawyer is doing every day.
You also have a message for founders around return on investment, and your take is don't become obsessed with ROI. I wonder how much of a challenge that message is in an environment of higher rates, and particularly when investors are calling for profitability from these tech investments.
It's probably unusual to hear a PE guy talk about don't focus on ROI, but you get to these periods in time where there's a need for innovation, right? For the last decade or so, if you were in software investing like we've been, commercial execution, sales, those kind of the themes, I think we're in a period now where it's around product, right? Which is how do I think about the end markets, what my customers are doing, how my products is going to develop. And there you have to innovate, right? This is about sort of thinking about how I can innovate and change what I'm doing. And innovation is not as easy to quantify in ROI, right? It's almost the best innovation happens when you're not actually quite sure what it is you're building and how it's going to pay back. And it does require a bit of a mindset shift, which is something we have tried to focus a bunch of our portfolio and a bunch of people we're invested with on over time.
Big day in terms of central banks, in terms of the focus on interest rates. How important is it for rates to come down for your portfolio companies? Traditionally, software companies, tech companies, high rates is a challenge. Is that going to be a catalyst when rates finally do come down for your portfolio companies?
A little. I would say most software that we're at least invested in is pretty resilient, right? This is kind of workflow stuff. It's mission critical. So you see a bit of impact for demand when rates go up. As they gradually come down, I would expect, few of the enterprise customers that we naturally sell software to be more willing to make investment decisions or buy new stuff. But it is a more muted effect than if you were in a very cyclical sector, and we're clearly in a sector which is just very resilient over the long term.
OK, Matthew, thank you very much indeed. Great to have you in the studio this Thursday. Matthew Brockman, HG, CEO and Managing Partner, on how software companies are adjusting to generative AI and the opportunities around innovation in that space. And sticking with the Gen AI story, one of OpenAI's former co-founders, says he is starting a new AI research lab. Ilya Sutskever has announced plans to continue work at a lab called Safe Superintelligence, focused on artificial general intelligence, or AGI. The famed researcher took part in the 2023 ousting of Sam Altman as OpenAI's CEO before changing course and helping engineer Altman's return. Sutskever later left the company. Coming up, threats and opportunities. How military tensions are giving a boost to one of Norway's biggest defence firms. Details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. The Bank of England is expected to keep rates steady later today, with the impending UK election making a move more difficult. Yes, politics overshadowing the difficult decision for the BOE, or maybe it's not such a difficult decision given the CPI and inflation data that came out yesterday, of course, with services inflation at 5.7%. Jackie Bowie, managing partner and head of EMEA at Chatham Financial, joins me now in terms of the preview of the BOE and what to look for in the months and quarters ahead. Jackie, let's start with the question of the statement that's going to come through, the minutes from the BOE. Given that rates are expected to remain on hold at 5.25, what are you going to be scrutinising within that statement?
Yeah, like you say, we're expecting rates to stay at 5.25 once again. And a more difficult day for the Bank of England given the election blackout. So there'll be no full press conference. So there's less opportunity to really get into the gritty analysis of the language they use. So we'll be relying on the minutes, so just the printed statement. And from that, really trying to get an idea as to whether the rate cut in August is likely to come. The Bank of England have been using language of kind of higher for longer, really talking about having this restrictive policy in place for longer than the market was anticipating. And that's really the shift that the markets will be looking for, to say, will they start to dial that back a little and maybe be slightly more dovish in their statement for the rest of the year.
Jackie, do you think then, is it your estimate or your expectation they can leave the door open, they do open the door to an August cut, or do you think there's caution now, given what we saw yesterday within the inflation story?
Yeah, I definitely think there is still room for caution. And in fact, the market is now saying kind of August is less likely. Again, it seems every time we get close to the meeting, then, the expectations get dialed back further. So in fact, we might be looking at September or even November for the first rate cut in the UK. And, you're saying, obviously, the headline inflation number looked very promising yesterday, hitting the 2% target. But actually, you've got to look underneath that. And the services sector inflation still high at 5.7%, higher than where the consensus was. And the Bank of England have emphasised before that is what they're looking at. It's that sticky wage inflation that comes through in the services sector that's causing the issue.
Well, how do they break the back of that services inflation? Just keeping higher for longer? Is that the answer, given the connections between wages and services?
Yeah, you've got to look at the connection. If you think rates stay longer, then does the economy slow down, tends to then lead to an increase in unemployment, which then takes the pressure off wages. So, there's lots of relationships and variables that have to change. So it is a bit of a fine balance for them. But the UK services sector inflation is high, even relative to other countries in Europe that have had higher inflation too. And it really comes into a lot of the, the public sector wage increases that have happened, and the UK has a very dominant services sector, of course, which means that wage inflation data has a higher impact.
We've heard from Hugh Pill, we've heard from Andrew Bailey saying that rates are in restrictive territory in the UK. How do we think about how much restriction is needed then to prevent a resurgence of inflation, given that many economists think that the data and the numbers will tick up towards the second half of this year?
Yeah, that's true. And of course, we still have these external factors which are kind of outside our control. If you think about where this inflation originally started from, was, of course, the supply side and the kind of global markets. So we're very much dependent on what's happening to energy, what's happening to global oil prices, and that's going to impact our inflation. But you're right, even though this 2% target has been hit, when you look at where economists are forecasting that inflation to go, there are some concerns that we might not maintain it there. And again, you've got to look underlying at the core inflation and this wage data that we've talked about.
OK, Jackie Bowie, managing partner and head of EMEA at Chatham Financial. Thank you very much indeed. Great setup as we look ahead to the decision from the BOE and what to think about when it comes to the statement and the further action in the months ahead for the Central Bank of the UK. Jackie, thank you. Now, on Monday, UK Business Secretary Kemi Badenoch and Shadow Business Secretary Jonathan Reynolds will go head-to-head in a live televised debate moderated by Bloomberg's Francine Lacqua. That's at 12:30 p.m. UK time on Monday. Switching focus now to geopolitics and the question of defence. As the war in Ukraine rages and questions loom about what a potential Trump presidency could mean for the NATO alliance. Politicians across Europe have woken up, finally, belatedly, some would say, up to the continent's new defence reality. This awakening has sent European defence companies to record highs, but the gap between political rhetoric and battle-ready hardware remains vast. Norwegian defence giant Kongsberg is taking a step to close that gap, opening a naval missile factory outside of the capital, Oslo. Bloomberg's Oliver Crook, of course, is on the ground for us in Kongsberg. Ollie, how does this small town in Norway then fit in to Europe's ambitions around having a defence strategy to meet the needs of the moment?
Yeah, Tom, it's sort of a surreal experience kind of getting here. You go through the sort of Norwegian mountains and the fjords and the valleys here into a really kind of small and sleepy town where you have just built a new missile factory here. And this is Kongsberg. This is one of the biggest defense contractors in Europe. And this is exactly what they're building here now. These are these naval strike missiles, also the joint strike missiles. And it really kind of puts the rubber of the road, this defense conversation that we've had in Europe. All the politicians saying we need to build up, we need to build up to build up. That costs a lot of money. This new facility that we're standing in that just got built, again, this starts operating today. It's a 150 million euro investment. And what they also need is the confidence, contracts going into the future that these investments make sense to make. Otherwise, there's no sort of point. But Tom, the other thing that we need to take into account, of course, is time. The idea for this factory started in 2021. This was before the war in Ukraine. So we're talking 3 years plus until you get sort of the idea of building out this sort of hardware and actually having it roll off the assembly line.
OK, so that time frame is important, isn't it, in terms of how we think about how Europe can get match fit for this new geopolitical reality. What the missiles behind you, the ones they're manufacturing there, Ollie, what are they? What are they used for? How are they likely to be deployed on the battlefield?
Yeah, Tom. So these are the naval strike missiles. This is what this is here. This is a 1-to-1 scale. I'm told it's not active. So in the front of it, you have the sort of all the navigational hardware, the sensors and all of that sort of thing. And what's really interesting is that the joint strike ones, which are the ones that are a little bit bigger than this, these are what go into the F-35s, the sort of pristine, state-of-the-art military hardware from the United States. And the reason they've selected these missiles is because Norway had very sort of specific needs for these sorts of missiles. First of all, this is 400 kilograms, 4 meters long, but it needs to be able to navigate over mountains, down fjords, and track the water. And these basically you can sort of set on a target in the sort of shore about 200 kilometers away, and it will strike them with extreme accuracy. And this is sort of the thing that you can put in the F-35s, but you can also put them on the back of a truck. You can put them kind of all over the place. So really sort of mobile, and you'll find them with the U.S. military, Poland, the UK. This is all over the world. So this all in this sort of small town in Norway goes out to the militaries and deployed in battlefields really all over the world.
OK, so that's the global picture. Ollie, as you stand there, hopefully at an inactive missile, talk to us about how Norway itself is building out its own defence. Of course, it shares a border with Russia. That's clearly a challenge, but it's also a country that has, this massive sovereign wealth fund. It is cash rich. What is Norway doing in this space specifically?
Yeah, Tom, Norway sits in a sort of very interesting place. Obviously, it's exceedingly wealthy from its sovereign wealth fund. But also, you have to remember, this war in Ukraine, it's benefited massively financially from higher oil and gas prices, sort of the only sort of seller here in Europe. So it's done very, very well. But it's also very sort of socially progressive, very sort of concerned about making the right decisions in terms of ethical investing. The sovereign wealth fund, for example, won't touch any defense company that has anything to do with sort of nuclear missiles, right? So there's a sort of contradiction there. It's also home to the Nobel Peace Prize here in Norway, but they've decided to sort of really change their track in terms of military spend. They want to hit 2% this year for NATO. By 2030, they're going to hit closer to 3%, and by 2036, they're going to be spending 4% of GDP on defense. So for Norway, it's a very serious concern, particularly with the border with Russia, not necessarily because of a military invasion, but also their oil and gas fields, which we know have been sort of targeted by drones and all kinds of other things that have been very concerning here for the government.
Oliver Crook on the ground for us in Kongsberg in Norway on the defence industrial complex of Europe and how it is trying to catch up in this moment of need, of course. Ollie, thank you very much indeed. Lots more from Norway, by the way, still to come. We're going to be speaking with the CEO of that company and to Norway's Defence Secretary later today. Oliver Crook bringing us those interviews, so stay tuned for that. Now to some other stories making the news this Thursday. The head of France's business lobby has criticised the campaign programmes of both the far right and the leftist alliance, saying they are a danger to the economy. Patrick Martin of MEDEF told Le Figaro newspaper that Marine Le Pen's national rally would cut the country off from the European Union. He also said the policies of the leftist New Popular Front would lead to 200 billion euros in extra public spending a year, financed by taxes or the deficit. Plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, it has been, of course, a challenging year in terms of the Treasury markets and how you positioned within and along the curve in the US on US sovereign debt. But we have a Bloomberg story out today and a chart that shows what's going on in terms of the losses that came through at the front end of the year and how things have recovered. You are now just down in terms of total returns on Treasuries year to date by about 0.1%. So that recovery has come through as markets bet, investors bet that prices, cooling prices in the US will lead eventually to a Fed cut. Of course, it's not fully priced until November yet, but you have seen that turnaround in terms of the views on the Treasury market in light of the inflation data and the economic data that's come through from the US. It is in stark comparison, by the way, to what's happening in China. Let's flip the board because China's bond market has been one of the best performing. The gains have come through. The money has flooded in to Chinese debt. And that is much more a story about deflation and expectations that the Central Bank of China, the PBOC, will be compelled to cut. Bloomberg Economics, though, warns that that probably won't happen until you get more clarity to the position of the Fed. So the Fed, of course, looming large in this equation as well. But again, China's bond market has just had a storming year as money has moved in. Not necessarily an indication of health, of course, of the Chinese economy. More expectations they will be compelled to cut because of the deflationary pressures there. We'll flip the board and look at what's happening with the UK, of course. It is, I don't know if you've been told this yet, but it's Bank of England Day, of course. Not expected to change the rate, 5.25%, with inflation data headline coming in at 2% yesterday. Under the hood, though, services at 5.7%. Markets readjusting. You saw gilt yields selling, particularly at the front end. The 2-year yields up between 5-6 basis points yesterday as markets readjusted, now pricing in a very small chance of a cut in August. You're not fully priced until September, potentially November, when it comes to the BOE. Pricing in 1 or 2 cuts this year. Well, he'll see how the statement today adjusts, if at all, that pricing. Reminder, of course, next week we're going to get the UK Business Secretary and the Shadow Business Secretary going head-to-head for a live televised debate moderated by Bloomberg. Markets Today, though, is next. This is Bloomberg.